It's another edition of the Trading Tips video newsletter, teaching you how to become a successful trader today. This video newsletter is brought to you by TradingTips.com.
Welcome to this TradingTips.com video newsletter. In this episode, we'll examine short selling, a strategy that can be used to make money in a down market. Without further ado, let's begin. Short selling allows you to sell shares you do not own. You do this by borrowing shares from a broker who takes the shares out of a client's account. The client doesn't need to know about this. You owe him the shares. You also owe any dividends paid by the company while you hold the shares too. But anyway, you take those borrowed shares and sell them on the open market, collecting the sale price, which is deposited in your trading account. Later, you buy back the shares, hopefully at a lower price. You then return them to the broker. For example, imagine the stock ticker XYZ is trading at $14 per share. You could place a short sell order on 100 shares of XYZ and your account would be credited with $1,400. If you later bought back the shares at $13 when the stock had gone down, your account would then be debited $1,300, leaving you with a $100 profit. If instead the stock went up to $15 a share, you'd be left with a $100 loss. Short selling allows you to make money when the market is in a downtrend. In fact, this might be the easiest time of all to make money. That's because when stocks are in a bull market, they tend to go up slowly for a longer time. But when stocks are in a bear market, they tend to go down very fast. Here is a 5-year chart of the Dow Jones Industrial Average to illustrate this point. But how do you identify the best stocks to sell short? Here are a few criteria. First, look for stocks that are overbought. This includes stocks with high money flow index and/or Williams percentage R values, or stocks with higher than average valuation metrics. Secondly, look for stocks that are not very highly shorted already. A short ratio of less than 3.0 or especially less than 1.0 means that a stock is very unlikely to see its price rise on short sellers covering their positions. There aren't many short sellers to begin with. Third, look for stocks with bad technicals, such as stocks at the top of their Bollinger Band ranges that are headed down, stocks that are at or near resistance, or stocks that have fallen through support. Another reason to consider short selling a stock is if it has seen heavy insider selling in comparison to its insider buying. Ratios of 10 or more shares sold for every one bought are particularly bearish and thus may make for a good short sale. Also, look at the prices paid by insiders. If they are buying shares at $1 a piece, thanks to insider options, but then selling them for $80, the number of shares may not be as important. Secondly, take a look at the stock's institutional support. Look to see if institutions have been buying or selling recently, as well as the total percentage of shares owned by institutions. And finally, look for a stock that's going against the bear market. A stock that's up when the rest of the market is down, but for no good reason, is often a great short sale candidate. Here's a screenshot of me about to place a short sale order on Microsoft, ticker MSFT. You see under action there are several choices: buy, sell short, or buy to cover. Buy is to open a new position. Sell is to sell a stock you already own. Sell short is what we're referring to in this video. Buy to cover is for when you want to close out your short sale position, hopefully for a profit. In conclusion, short selling lets you make money in a down market. Instead of buy low, sell high, you sell high and then buy low. However, since there's no limit to how high a stock can go, there is no limit to your potential losses. If you short a stock at $10 and it goes to $200 a share, then you're on the hook for $190 per share. Of course, this isn't likely to happen, as your broker will do a margin call to prevent such huge losses. This brings up another point. A margin account is required for short selling, since it is possible for you to owe money. You may also have to pay a small amount of interest on your borrowed shares. Nevertheless, in a down market, short selling is the only way to go. We hope you've enjoyed this TradingTips.com video newsletter. Thanks for watching and good trading.
This Trading Tips video newsletter has been brought to you by Manny Bacchus's First Hour Trading System. Every day there's money to be made in the first hour of stock trading. This is the world of day trading, not for novices, unless you have a system. The First Hour Trading System. Visit firsthourtrading.com now and sign up for a free 30-day trial. You could make enough in the first hour of your day to take the rest of the day off. View more Trading Tips videos. Visit TradingTips.com. Sign up for our free video newsletters and become a successful trader today.